You always hear so much about retirement planning, right? I mean, it just seems like that's all that anybody talks about. But what's interesting is the biggest issue that we see when we sit down and talk to folks about sort of engaging in that conversation about making that transition to retirement is not necessarily a failure of retirement planning, but a failure to really think through retirement income planning. So on this segment, we're going to talk a little bit about what the difference is between those two, retirement planning versus retirement income planning, and sort of what you need to know in order to achieve that successful retirement income plan. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast. So make sure you go to our website at nelsonfinancialplanning.com and look for the icons that will immediately connect you over to our channel on your favorite podcast platform, or even on YouTube as well. If you want to see how much I do this radio show by talking with my hands, you get to see all of that on our YouTube channel as well. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries as well. You got the pleasure of meeting our newest one, Chet Cowhart, here earlier this month on one of the programs. And ultimately, they are ready this week to help you improve your life with a successful and cost-effective retirement plan, financial plan, most importantly, retirement income plan. So let's start with that difference between what's the difference between a retirement plan and a retirement income plan. A retirement plan, I think, is what everybody sort of gravitates to because it's probably the most straightforward part, right? The retirement planning part asks the question, well, do I have enough? It's sort of like that. If you think of it from a business perspective, it's sort of like that balance sheet analysis, right? How much do I own? How much do I owe? What are my assets? What are my liabilities? And to a certain extent, with the retirement planning, there's a little bit of a lack of control, if you will. Now, obviously, you have full control over how much money you save along the way, things like that. But you don't necessarily have full control over the value of your assets at any given point in time, right? Because that's a natural reflection of the underlying volatility of both the stock and the bond market as well. So you don't really have that as full of control on that retirement planning side of things. Not full control, of course, over what the economy is going to do, what the market's going to do, how that's going to affect the value of your assets, and of course, inflation, right? Those things are independent of what your retirement planning aspect is. Now, if you think of retirement income planning, that really starts to dig into more the almost like the P&L side, right? So if you got a business, you probably know to look at your balance sheet because that shows what you own, what you owe. But then your income statement, your profit and loss statement, that tells you how much money's coming in and where the expenses are, and then ultimately how much you get to keep. And that's sort of the core of retirement income planning: is where should you get money from? What's going to be the tax implications of it, and where should you really focus on in terms of generating that income, and what's the timing of it, and what does it look like for the beneficiaries? All of that are aspects of retirement income. So with retirement income planning, there's really a lot more control, if you will, over where you're going to get the income from, because, right, you can pick and choose exactly where your income comes from in retirement, but you have to do it properly, right, in order to understand some of the pitfalls in order to make good decisions. So with retirement income planning, we thought we would just kind of give you three things to kind of consider when you're thinking about retirement income planning. And of course, first and foremost, it has to start with Social Security, right? Social Security for most Americans is a pretty good chunk of the income that they're going to get during the course of their retirement. So you have to understand Social Security withdrawal strategies, application strategies, things like that. Obviously, we're not going to get all into that on this episode. If you're curious about some of our philosophies on Social Security and when to apply for it, when to take it, make sure you go to our category or our catalog of past shows, whether that's on your podcast platform or whether that's on YouTube. Look for the shows in particular that feature myself and a fellow certified financial fiduciary, Rob Field. He also happens to be a national Social Security advisor. And those oftentimes will then feature an extensive discussion of Social Security. So want to learn kind of more details about that. We referred you to many of the prior episodes that we've done. But the issue that gets missed, I think, with Social Security, and you should see the look on people's faces when they learn this for the first time, is that Social Security, in fact, is taxable. Now, there are certain income levels where it's not, but those are pretty low, and they haven't ever been indexed for inflation over the past 40 years, so they haven't really changed. So more and more people find that they are paying taxes on their Social Security. How much taxes you are paying on your Social Security depends on how much other income. So at certain levels, okay, very low levels, then you're not going to maybe pay anything of tax on the Social Security. And then at other windows, there's 50% that might be taxable, all the way up to the highest level, which is 85% of that Social Security being taxable. So in terms of retirement income planning, the first thing you always got to kind of wrap your hands around is Social Security, because let's face it, that is a large part of most people's income in retirement. But it's taxable, which gets us to the next category of discussion, which is that getting an understanding of your taxes, because particularly from a retirement income perspective, this is really where you can make the biggest difference, is knowing the tax nature of the assets that you have as part of your retirement plan, but then really looking at, okay, where does it make sense to take the retirement income from, and at what times should I be doing that? And that really requires you to sort of know the split, is what we kind of refer to that. The split between assets that are going to be taxable fully as ordinary income, and taxes that will be less, in buckets that will be less taxable. So that might be after-tax monies, that might be Roths, that might be things that generate out dividends, capital gains, things like that. Because remember, dividends and capital gains are taxed at lower rates. And if you're a couple making less than $120,000 per year, you're going to find your dividends and capital gains for your long-term capital gains rates is actually zero. So that's pretty tax efficient, and certainly something that you want to be aware of as you're plotting out that retirement income picture. And then thirdly, of course, is inflation, right? That's always there. And you probably want to assume 3% and not the 1 or 2% that we might have seen in the past. If you look at historical averages, it's right around 3%. So you probably want to take that as your assumption. The reality is, while 3% doesn't sound like much, over 12 years, something that costs $10 is now going to cost 15. So that's a problem. Dealing with inflation goes to your investment allocation, right? You still need some level of growth in some parts of your portfolio. If you're retiring at 65 or 67 or whatever the case may be, that's still a good number of years in front of you. Think about that example, right? In just 12 years, the $10 item is going to cost 15. That means you're going to need some growth, some return more than that 3%. And so where you need to be careful is don't overload on the bond side. Far too many people, they get to retirement and they hear the message of, oh, you got to be 60% in bonds or something like that. No. You really need to be thinking about this more from the perspective of inflation and taxes, and what's the impact going to be. So those are just some of the key considerations, if you will, the key differences between retirement planning, which kind of everybody talks about, and retirement income planning, which is far more nuanced and detailed, and ultimately something that you can control and make a real difference in your retirement. With that, we're going to take a break, and after these messages return here on Dollars and Cents with Joel Garris of Nelson Financial Planning.